On behalf of everyone at Ferguson Wellman and Westbury Investments, thank you for joining us for our second quarter investment strategy outlook. So much about what has happened in the last year has been unprecedented, from the virus to the massive global government response. However, one thing has been pretty consistent with history, and that has been the capital market response to the last year. From the bear market in stocks to the sharp rebound when the end of the pandemic came into sight has been right out of the capital markets playbook. This is why we chose the 1980 movie Back to the Future for our 2021 outlook. For this quarter, we continue the theme from the movie. Approaching 88 miles an hour. 88 miles an hour is the velocity in which the DeLorean would go back in time, and we thought it was a good analogy for the current economy that is accelerating rapidly due to the unprecedented monetary and fiscal stimulus. Consumer spending is set to rebound sharply as the savings rate has been 6 times the normal amount, even before the last $1.9 trillion stimulus. Pent-up consumer demand, particularly for services and travel, should be unleashed as vaccines are accelerating. One of our research partners has dubbed this phenomena revenge spending, as consumers venture out of their homes to make up for lost time. In addition, housing and housing-related spending continues to boom as mortgage interest rates remain low. One of the most frequent questions we have been getting from clients is about the specter of elevated inflation. The monetary policy or financial engineering of the Federal Reserve to stimulate the financial system, coupled with cumulative $5 trillion of fiscal stimulus from Congress, has put the economy on a path to accelerate rapidly in 2021. While there will be a sharp uptick in inflation in the near term, this is due to a base effect as we lap the deflation of the first part of the pandemic. Our view is this elevated inflation will be transitory and will settle out at a lower level as we get past the anniversary of the pandemic. Inflation has not been a problem for the last 25 years, and we don't anticipate it being a problem now. We expect inflation to remain well anchored. In its most elemental form, inflation is too much money chasing too few goods, which causes prices to rise rapidly. Looking at history, if the dot-com bubble, $140 oil, or 3.5% unemployment, all potential inflationary events did not cause inflation, we do not see it happening now. Deflationary forces that were in place prior to COVID will still be in place after COVID. Aging demographics, the increase in technology, and an excess of savings worldwide. If there is elevated unscripted inflation, the Fed has tools to deal with it. Increasing short-term interest rates or tapering bond purchases. We see interest rates rising gently this year for the right reasons, which are anticipated increased economic growth and a normalization of inflation expectations. Our view is that the 10-year Treasury could go from where it is now at 170 up to about 225 by the end of the year, still historically low. Fed Chairman Powell recently said that an increase in interest rates this year is a statement of confidence by the markets in the economic recovery. Stocks have had a massive move since the bottom of the market in 2020, and there have been concerns about valuation in the market. However, even with the S&P 500 up more than 10% in the last 6 months, stocks are still cheaper. This is because earnings estimates are going up faster than stock prices. We continually say only 2 things matter with stocks: what are earnings and what are investors willing to pay for $1 of earnings. Over the last 6 months, with stocks up 10%, earnings estimates are up 20%, making stocks 10% cheaper. There has been a shift in market leadership. What stocks worked last year are not what's working this year. The announcement of the Pfizer vaccine was a turning point for the stock market. In the 6 months prior to the vaccine announcement, growth stocks were up 31% and value stocks were down 8%. With growing confidence in recovery, there is a shift in outperformance of value stocks and economically cyclical stocks. Vaccine distribution and stimulus will continue to be tailwinds for the economy. We've allocated away from fixed income to alternative investments to increase the income generation and total return. Within stock portfolios, we are overweight financial, energy, and industrial companies, which typically do well early in an economic cycle. Our view is that interest rates will be historically low for the investable time horizon and it will be difficult to make money in bonds. As a result, we are close to as underweight bonds as we have ever been in the history of the firm. Within bond portfolios, we are short duration due to a gently rising interest rates and overweight corporate bonds which do better in a recovery to make the best of a challenging environment. The other question we get frequently from clients is if we are due for a correction. We are not due for a market correction, we are overdue for a correction. On average, the market declines 14% each year from peak to trough, which is illustrated by the red diamonds on the accompanying chart. It is not a heroic prediction to say that a correction is on the way. Historically, when you've had a move in stocks this large off the bottom in a bear market, after the initial rebound, the market will often go sideways for about 6 months. A market correction is not a tradable event, and we are not sure what the cause will be. However, it is coming. It's important to remember what separates a correction from a bear market. Bear markets are rare and are due to a change in economic cycle, and the decline is usually more than 30%, like we had in the last year. A correction is less severe and is not the result in a change in economic cycle. We still think we can make money in stocks this year, however, it's not going to be a smooth ride. Thank you for joining us. On behalf of all of us at Ferguson Wellman and West Baring, it is a privilege to serve you, and we look forward to connecting with you at the end of the second quarter in June.